Okay. So like I mentioned, we're going to take a closer look at 2021 and then also a little bit of what to expect in 22. So after 2021, most people, you opened your statement, you looked at your account, just looked at general financial news. You might have started off the year feeling like 2022 was going to look a lot like this for you, a little bit of a party. What's happened through the month of January, though, is we see something that looks a little more like this. And so one of the things that we're going to address today is why that's happening, why we feel like 2022 is still going to be a positive year, still a constructive outlook, so to speak. But there are some things to keep an eye on and things that we're going to continuously keep an eye on as the year goes on to see, where are we going to actually end up? So looking back to the fourth quarter of 2021, up on the screen, we have a few charts and some key stock market index performance metrics. And so for Q4 of 2021, the S&P 500 was actually up about a little over 11%. You could see the NASDAQ and Dow Jones, a few of the other major indices that are tracked. So in the United States, all relatively positive. In global markets, we did see that two subsets of the market were positive, with the exception of emerging markets, but significantly less than the performance that we saw in the US. When we break down the market as a whole and we dig into each individual sector, we can see where some of the performance weighting has carried through, not just through the pandemic and the start of 2020, but also through 2021. So we saw the technology sector still at the top of that list, returning 16.66%. Industrial and energy started to catch up a little bit. Where we did see a bit of a pullback is actually in communication services. So these individual ETFs are really a representation of how you as investors can participate in different sectors of the market. Defensive sectors did really well: healthcare, consumer staples, utilities, and some of the cyclical sectors that we look at, like real estate, raw materials, some other consumer discretionary and financial services, all positive, but real estate and commodities actually last year were some of the biggest winners. So if we look at and break down asset classes, so on the right side of the screen, you'll see different types of assets and the corresponding index that you can kind of use to benchmark how those different parts of the market are performing. And so one of the things that we saw in the beginning of 2021 is that many investors and institutions were a little bit skittish about commodities, real estate, and some other areas of the market, specifically with real estate, commercial real estate, what will happen with that industry, with everyone going to remote work, and a bunch of other factors that obviously needed to be taken into consideration. Some people were proceeding with caution with those types of investments. As it turned out, those ended up being our year-to-date winners for 2021. Commodities being up 40%, over 40%, and U.S. real estate being up 38.7%. Now, the S&P 500, the broader U.S. market, was still up about 28.7%. And we saw growth in value, a story in 2020 that there was a much wider spread. The growth segment of the market greatly outpaced value. And last year, we saw value pick up some of the pace. And you could see there that some of the other the asset classes also performed well, with U.S. small cap doing relatively well. And then the rest of the world, which has significantly underperformed US, over the past decade. Some places where we saw pullbacks, minor, but bonds, with interest rates being at historic lows, that was one place where we didn't see a lot of momentum. Emerging markets was another that lagged, and US Treasuries. So one of the things that we always talk about with clients and other investors is that we want to look at portfolios in a diversified way. So not everyone is just investing solely in the S&P 500, the NASDAQ, the Dow Jones. Most have some combination of various indices. built into their portfolio. So what you can see here is a performance of a diversified portfolio in comparison to a S&P 500, for example. So the sample risk model, we broke it down as aggressive, balanced, and conservative. So an 80-20, 50-50, and a 20-80. And what you'll see in this chart is that the S&P 500 outpaced some of the diversified portfolios, but you'll also notice in the chart here on the bottom, some of the volatility that occurred within the S&P 500 getting to that point. And so you'll see these sharper dips with this green line. And what you'll see is that, you know, it's a different ride, so to speak. So January and much like the start of February, the market has been a bit of a roller coaster. It's important to emphasize that what your experience is on that ride is ultimately going to lead to investment success. So one of the things that we focus on in having these conversations is that investment return is not always the same as investor return. And that's just based on your participation, you know, how long you're participating, staying the course, and then also not having disintermediation or moving money in and out of the market for short. So this definitely paints a picture. Obviously, had you invested in just the S&P 500, you would have greatly outpaced, but you also would have had to weather some pretty significant dips month to month going through 2021. A huge topic of conversation through the end of the year and ultimately into 2022 is what's going to happen with interest rates. So interest rates are something that we're all paying close attention to. We've seen 10-year treasury yields, for example, have climbed pretty significantly to start 2022. In Q4 of 2021, we started to see some change, but not really much. That's really accelerated here, and there's more rate hikes expected. Why that will be important is when looking at other types of fixed income investments in the marketplace. So you'll see some names up here like high yield, corporate bonds, US high yield, as well as obviously government and treasury securities. So changes in rates over time in those securities may make them more attractive again, but that also could have a more short-term effect on equity markets. So something to keep an eye on. The Federal Reserve has said on many occasions that they're anticipating raising rates throughout the course of this year, possibly several times. So this is one of those areas that we're going to keep a close eye on to see, you know, if those are going to happen when they say and by how much. So digging into the macro, we talked a lot about markets and what happened with markets. Now we're going to dig into macroeconomic data and looking at, you know, where do we stand economically? Where are we in the cycle in different areas of the market? And so this is a visual representation. This is the macroeconomic dashboard that we actually, we have a PDF version of this that we can share, and we'll share with all of you, as well as the slide deck. This is just showing where we are in the overall economic cycle. So right now you can see the different industries or the different segments of the market and where they fall on this heat map. You know, all the way to the right where we're seeing contraction, things like monetary policy and autos. You know, we're seeing obviously the Federal Reserve is pulling back on certain things. Fiscal policy is something that's slowing and a major concern. Labor, profits, things like that are directly tied to inflation, for example. Some of the things that we're seeing challenges. Now, there are still parts of the market and the economy that are in growth and expansion phase. So capital spending, capital expenditures are still growing. The energy industry, which one that took a pretty big hit in 2020, you know, our trade and trade imbalance and levelizing that, you know, housing and credit are also kind of peaking in that growth phase. Where we're still seeing areas or potential expansion is commercial real estate. At the beginning, I talked a little bit about how there's been such a pullback, people going to virtual work. What's happened is that many REITs and other commercial real estate managers have made some changes in how they're offering office space, what office space really looks like in today's world, and what it might look like moving forward. And so some positives that we're taking away from this is that there's a record labor demand. Unemployment has drifted back below 4%. There's still consumer demand. There's still some pent up demand out there. I know we're still lingering through the coronavirus pandemic. There's been talks that we're closer to the back end of that cycle than we were in the beginning. And so those are things that are going to open the world up, and maybe some of that pent up demand and those cash reserves that have been sitting on the sidelines will actually be spent. Compensation growth is something that's happened over the past year. Not to the same rate of inflation after the numbers came out the other day, but it is something that we feel could be a positive for when we're talking about the macroeconomics of what we're looking at, and more importantly, how that translates to market returns. And going back to capital expenditures, software and R&D is something that's been bumped pretty significantly. But again, the biggest concern moving forward is going to be inflation. The word transitory has pretty much been thrown out the window at this point. I think we all have agreed that transitory means temporary. What's happening right now is not necessarily temporary and may continue for an extended period of time. There's differing opinions amongst economists on how long that actually will be. Could be 12, could be 18. Some of the issues with things like supply and demand imbalance, with capacity, manufacturing, not being able to get products out to consumers quickly enough, has created some of the inflation and things like automobile sales and housing to some degree. So something to keep an eye on, and something that we're going to be looking at. And so this is just a more comprehensive explanation of each, why they're in those different phases of the economic cycle. And much of what's in here is what I just described. So we'll move on. So I talked a little bit about U.S. housing market data. The housing market has really continued to be an interesting sector to keep an eye on. Consumer preferences have really shifted with the pandemic. And ultimately, the change in interest rate environment has also changed the housing market pretty significantly. At the beginning of 2021, we saw the lowest 30-year mortgage rate, along with the highest number of mortgage originations, over the past 30 years. And since then, mortgage rates have obviously creeped a little bit higher with the increase in the 10-year treasury, for example. That's also led to a decrease in mortgage originations. So, with refinances potentially cooling off, but also still a strong housing market, we may see a shift of the balance between new purchases and refinances start to levelize, and more of the market may be propped up by new purchases. But the market is still in a growth phase. When we go back to our macroeconomic dashboard, there's still a demand and there's still a shortage of available listings. So those are things to keep an eye on, and seeing when that growth actually peaks, and also seeing how continuous growth in interest rates will affect that area of the market. So next, the US dollar strength, as the CPI, which is really just a measure of inflation, as that continues to increase over time, the purchasing power of the dollar naturally has gone down. This has also changed the landscape of the US dollar. When we look at it in comparison to other currencies, the US dollar to the euro, for example, to pound sterling, Japanese yen, it's all increased to highs in the fourth quarter of 2021. Again, something to keep an eye on. Definitely will be heavily tied to inflation, and we'll have to keep an eye on, see if wage growth keeps pace with inflation. I think the general consensus is that's probably not going to be the case. Obviously, we saw the beginning of this year, Social Security had a pretty large, one of the largest in a very long time, cost of living adjustments. So US dollar strength will be directly affected by we have a sustained level of inflation. So this is another interesting area of the market that we're going to keep a pretty close eye on, and that is going to have a direct consideration in investment decisions moving forward. So again, looking at the CPI, we're kind of at 20-year highs. This chart goes back to December 31st of 1989. Inflation has been the talk of the town for a while now. This is not anything new. December's rate was around 7%, and that's translated directly into higher consumer prices. I think we're all living and feeling those changes. The core consumer price index, or CPI, less food and energy prices, was actually still about 5.5%. So we look at these, kind of separately, the consumer price index as a whole, and then we look at the core consumer price index, which takes certain things like food and energy out of the mix. Even by subtracting those, inflation still clocked in at 5.5% at the end of Q4, which is still at a 20-year high. So this is not going anywhere anytime soon in terms of a topic of conversation. People are going to keep a close eye on it. And that's also why we've seen some of the drastic swings in the market over the past month and a half. So we expect that to continue to some degree as data continues to come out. And so there may be points throughout this year where we're going to see those bigger swings day to day. But ultimately, again, we're going to revert back to the macro data and see, is this something that will be sustained long term? If it is, how does that affect decisions and investing moving forward? The other piece of all of this is focusing in on companies that have had a greater impact on the performance of our broader indices. So for example, the comparison between these two ETFs, one is a representation of how a smaller subset of stocks in the S&P 500 has really affected, our ultimate rate of return over the past several years. And so the equal weight S&P 500 ETF versus the Spider S&P 500 ETF is just showing the difference between those two, that there have been outperformers since the market's bottom in March of 2020. And the performance spread on that bottom panel will increase with the equal weight index. And so, really boiling that down into a really simple explanation, there have been some companies that have just done so well that they're carrying the broader index. But if we split up our dollars equally to all of the companies in the S&P 500, what we'll see is that we don't do as well. So, a lot of big names there to discuss, those that we've all heard of, companies like Tesla, the Facebooks, Googles, Amazons of the world. They all had, historic growth throughout the beginning of the pandemic. So, talking in the trough of March of 2020 to, where we are today, historic levels of growth. And so those individual companies, really a handful of individual securities, have carried metrics like the S&P 500 as a whole. You could see the index has an equal weighting has still performed pretty well, but it is lagging, and that's just due to some of those companies kind of carrying the load. Where you'll see bigger dips in these types of funds. So for example, if you're invested in just a general S&P 500 ETF, you are going to mirror the performance of that index. And so with that, if you see a day like we had the other day where Facebook had a 25% dip in one market trading session, that's going to affect things like the overall pricing of the S&P 500. In this equal weight option, you may not see or feel it as much. So it's a double-edged sword. The index investing is great for broad diversification, but what we've seen over the past few years is that, especially since March of 2020, is that there are a few companies that have really carried that load, and that also the inverse of that can happen. So you see those great spikes, but you can also see major pullbacks. And so, it's expected that 2022 is going to be a relatively choppy year, but that's just something for your own knowledge when you're looking at investing in the market. Take these types of things into consideration. Another piece of market performance, especially through the end of last year up until this year, is mixed coronavirus data. So the Omicron variant of COVID-19, was identified in the fourth quarter of 2021. It's proven to be highly transmissible. Proportions of daily positive cases reported that have resulted in more serious or hospitalization, though, have gone down pretty significantly. Death due to coronavirus is at an all-time low. And a lot of these percentages are starting to dip lower. So what we're seeing is case counts potentially going up, rates of infection going up, but some of the more serious metrics that we adhered to at the beginning of the pandemic really aren't correlating with that. It's not a proportional spike. So that leads us to believe that the amount of the effect that coronavirus specifically will have on the markets moving forward is going to start to diminish a little bit. That's our view. That's not a shared view by everyone else in the marketplace, but we feel that as we get closer to the finish line of getting out of a pandemic phase and into more of a seasonal flu type of capacity, so to speak, where it's just something that we live with, we have treatments, we have vaccines for it, and we move forward, that coronavirus data will become less significant over time when we're talking about effects on the market. So that's a little bit about what happened over the last year. So let's talk a little bit about where we are now. So if you get our weekly market updates, this is something that we put out every week. We also have monthly market insights, but there's a snapshot in those emails, which I've included here, which really just shows us our progress throughout the course of this year. So at a high level, to hit on some of the few things that we've talked about, it's been a relatively choppy year. At one point, the S&P 500, if I look at the bottom of that chart, it was down at one point double digits, 10+%. We started to claw our way back. Now we're down about 5.5%. And over the last week, this is as of market close Friday, it was up for the week about 1.5%. You could see some other sectors of the market. The NASDAQ especially has been hit pretty hard just because the technology sector. We've seen a little bit of a pullback. I think to some degree too, as we come out of this pandemic, that segment of the market will not be as strong from an investment performance perspective as it's traditionally been. That's just a function of crazy valuations, crazy growth, and to some degree, some of those fundamentals tend to work themselves out, and stocks in that sector will revert themselves back to kind of a mean or a new normal, so to speak. And so you could see over the course of the week what happened, Monday, Tuesday, Wednesday, a little bit of a pullback Thursday, and a bump on Friday as far as the daily close of the S&P 500. It's important to note that we're still creeping up around historic levels. So even though we have these fluctuations, we're feeling like the market is potentially having a pullback, but really what we're experiencing is just extreme volatility. A lot of different reasons why. I think one of the biggest things is the emergence over the last 2 years of retail investing. Money in the retail investment world moves much quicker than institutional. And that can have an effect on the markets. That can have an effect on returns. And so we focus pretty heavily on when we're talking to clients and talking you through an environment like this one, we're going to focus on strategic asset allocation, not as much about timing, but more about having a more fundamental approach to investing and picking and choosing areas of the market that, one, we feel over the long term will perform well, but more importantly, trying to find value. One thing where retail investors especially have struggled coming into 2022 is finding value in the investments that they've adhered to, or they've really anchored themselves to over the past 2 years. So the technology sector is a big one. It's done really well. Moving forward, I wouldn't have expectations that, in certain individual companies that you're going to get 250, 300, in some cases, almost 1,000%, if we use a Tesla, for example. Getting those types of rate of returns on a consistent basis. It's obviously not sustainable, but more importantly, as we come out of a pandemic into a new normal, life will change slightly, but certain things will have staying power and others won't. And so we're looking really heavily at maintaining quality positions when we're investing, maintaining good diversification, but also maintaining, broad exposure to different areas of the market so that we can capture some of that value, especially when we look at outside of the US, the rest of the world, and more importantly, emerging markets. That's one that's lagged pretty significantly over the next decade. And I think that's one where we see a lot of opportunity for growth outside of the US. Down at the bottom, we talked a little bit about interest rates. So over the course of this year, pretty big jump, year to date, as of last Friday, the 10-year treasury note has jumped, 0.41%. So the close at that point was about 1.93. Why that's going to be important: rising interest rates, also things that we talked about, mortgages, the housing market, debt, how companies are going to acquire cheap debt, if that's still going to be available, if so, at what rate. And then on the positive side of investing, as interest rates go up, financial institutions tend to do pretty well. The reason is charging more interest, but the lagging effect of them actually trickling that down, that interest, to things like savings accounts and other vehicles, that banking instruments, it lags a little bit. So that spread, or that arbitrage that they experience in the interim, tends to make banks a little bit more profitable. So those are some sectors we'll keep an eye on in a growing interest rate environment. But as a whole, we're seeing markets down for the year, but it's starting to make its way back. And ultimately, this changes day to day. Going back, making a little bit of a lighthearted joke with those two gifts, but that's really been the experience for many people. One day is a party, and one day is a little less of a party, or maybe even sad, depending on how you're invested. And so it's going to be a bit of an emotional roller coaster, but we feel like the outlook for 2022 is still pretty good. So, from our perspective, constructive outlook heading into the rest of this year. Economic growth is still actually considered to be pretty robust. There's record labor demand. There's pent-up consumer demand. Consumer balance sheets are still relatively healthy. The savings rate, especially amongst millennials and Gen Xers, is higher than it's ever been. Job market is still relatively strong. There's a lot of competition out there. There's a lot of folks that are trying to poach competition. And so we'll really see how that affects companies moving forward. And then also, monetary policy still is relatively accommodating. It's going to get less so over the course of the year, but as of right now, it's still relatively dovish. And so that's something that we feel is a positive going into this year. And again, I think the expectation is a positive year from a market perspective, from an economic perspective. To what extent, I think it would be unreasonable to expect levels we saw in 2020 and 2021, but still seeing some level of growth into 2022. It's going to be choppy. It's going to be more about finding value in the market, staying well diversified, but overall, our outlook is positive. There are some important things that you're going to want to monitor throughout the course of this year. And one of the things that we're going to be monitoring, we talked about them at a high level: inflation. When we made this presentation, I think the question of transitory or structural was up in the air. The further we get into 2022, I think the word transitory has expired, and we're really in a phase where some segments of inflation, or some areas of inflation, are here to stay. They're not necessarily going away. Others could be transitory, but more in a transitory, not in a short-term sense, but they're temporary, but temporary from a long-term perspective, if that makes sense. Kind of counterintuitive, but ultimately things like goods and services, or goods specifically, excuse me, that need to be manufactured, the cycle of manufacturing and getting those out and meeting the demand with supply, that's going to cause natural inflation and price hikes. And so with that, we'll be curious to see how that all actually ends up playing out over the course of this year. And then, as I mentioned, monetary and fiscal policy, becoming less supportive or less accommodating. That's something that's definitely going to have a direct effect on markets. I would argue that to some degree, we place too much emphasis on certain things in the short term, and that really looking at things from a macro and a long-term point of view is going to be much better for you. It's going to be much, it's going to help you sleep at night too. Not getting overly concerned with the day-to-day of these things. Market swings are going to happen. Again, this just has to do with the behavioral nature of investing, number one, but two, the ease of access to making trades, creating transactions, and creating turnover in the market. So fund flows are going to be larger than we've ever seen, most likely. And that's just something that it's the nature of the beast now. It's something that we're going to have to learn to live with. But overall, fundamentals, I still believe ring true. And those are the things that are going to ultimately determine the macro movements of the market as a whole. So with that, a lot of information really quick, but I want to open the floor for questions. I know there's a chat feature in the Zoom. So I want to give everyone an opportunity. If you have any questions, please feel free to share those. You can use Q&A or chat. Throw those out there. We're happy to answer them, and hopefully everyone is still engaged and awake. I know a lot of like drinking water through a fire hose, but we're still, to summarize, we're still excited about 2022, but many things to keep an eye on. So with that, I'll turn it over. If we have any questions. Great. All right. Thank you. And thank you all again for joining too. Lunchtime on a Friday. It's a nice day outside here in Maryland. So if you're here, please, after this, get outside, go for a walk, maybe eat lunch outside, enjoy it. And hopefully this was all helpful. If anyone has any questions for us and you want to ask offline, you have anything more specific that you're curious about, please let us know. We're here to help. Ultimately, our job as financial professionals and financial advisors is to be educational in nature. So we're here to help. If you have questions specific to your own situation, or more importantly, just about anything in the presentation, as I mentioned, everyone's going to get a copy. You'll all have an opportunity to review the slide deck after we get off the call here. So, with that, I'll leave it open for a few more minutes. We'll run this, Devin and I will sit here until about 12:45 for any of those that want to ask questions. And if not, feel free to leave. I'll kind of turn off I'll stop the recording at this point. And thank you again for those that are still on, and please enjoy the rest of your weekend. And hope you all have a great day and enjoy the rest of your Friday.